I'm John Bartoletta. Today's August 16th, 2013. This graph represents the relationship between the Federal Reserve quantitative easing program and the performance of the S&P 500 index. When the stock market and the financial systems began to collapse back in 2008, the Federal Reserve needed to stabilize the system with the financial tools they had at their disposal. At that time, they had to use their balance sheet and the injections of money to support the system and stop the hemorrhaging that was taking place. This also acted as a foundation for the system to start repairing itself by using massive amounts of money to stabilize the banking system and bring confidence back to the marketplace. As you can see, from 2008 to present, the Federal Reserve has pumped a record-setting amount of money into the system, as indicated by the blue line. The result has been an unprecedented move up in the stock market, shown here as the red line. Strong growth markets tend to move higher at a 45-degree angle relative to strong economic data and a fully employed economy. Twice in the last 5 years, the markets have been rocketing up at a 63-degree angle relative to economic data that was poor but getting better, and high unemployment, which was not so favorable. The first time was 2009 to 2010, where the S&P 500 rallied based on hope of a recovery and the new Federal Reserve stimulus. The second time was late 2012 to 13, where the Federal Reserve and the markets were in sync at an alarming rate. Both the Federal Reserve stimulus and the markets are again at an unsustainable 63-degree angle. As the economy starts to show signs of holding its own, we do not believe it has, the Federal Reserve needs to begin to slow down or taper the injections of money that are pumping into the system. When they do, whether it be September or December, the markets will have to correct and find an efficient price level that will equal Wall Street's perceived corporate earnings and the growth rate of the economy. With all of these headwinds, slower corporate earnings, seasonality, Fed tapering, and a market that is at record price levels versus its own 200-day moving average, we believe that a 9 to 12% correction is needed. The red and the green price levels to the far right indicate a 3% correction and represents the S&P 500 50-day moving average, and a 9% correction, which represents the 200-day moving average. Markets tend to move to these levels in times of uncertainty. The first level was reached last Friday, and we feel that the next level could be reached in the next few weeks. In late July, in the face of all these headwinds, we felt the time was right for profit taking. We started positioning our portfolios for the short side of the market. At that time, the S&P 500 index had the highest price spread in history above the 200-day moving average, with all technical indicators also showing overbought conditions. In our equity accounts, we raised cash to 20% and added a 12% weighting of the S&P and NASDAQ double short ETF. We are attempting to lock in profits in the portfolio while reducing volatility or portfolio exposure during this pullback in the markets. When we see signs of the market finding a new base, we will remove our short position and then look to reallocate cash to positions that show upside potential. With that said, we remain committed to our forecast of a corrective move down of 9%, followed by a strong fourth quarter rally to possible new highs by year end. Over the next few weeks, we'll keep you posted as market events happen. Enjoy the rest of the summer.